Hello, good evening, viewers. Welcome back to GBS lecture series. I'm Mohammed Aashikkhan, the principal consultant and the managing director of Global Business School Sri Lanka and Middle East. Today, I'm planning to discuss the next standard in my lecture series on accounting standards. Today, I'm picking up IAS 2. As 2 is accounting for inventories. Any given accounting standard will have a certain format of reading and arrangement. That reading and arrangement is given here. You have first we need to talk about objective of the standard, then the scope of the standard, and any given terms defined, and then the technical discussions related to the standard. So accordingly, we will now try to go through in this order. First of all, we need to find out the objective of IAS 2. The objective of IAS 2 is to discuss the accounting treatment for inventories. Accounting treatment for inventories. So that is the basic objectives of IAS 2. So now let's go through a little bit more in detail as to what are the objectives. The IAS 2 sets out the accounting treatment for inventories, including the determination of cost, the subsequent recognition of an expense, and any write downs to net realizable value. So anyhow, the objective is that. And then we need to talk about scope. The IAS 2, the treatment of accounting for inventories, will not address the following related items. So, which are not covered here are, one is that accounting for inventories. I'm sorry, not accounting for inventories, accounting for financial instruments. Accounting for financial instruments we will not discuss in IAS 2. This is specifically covered in IAS 32, 39, IFRS 7 and 9. So these areas where any stocks and shares and the debts, whatever related to financial instruments, we will not be discussing or covering in IAS 2. Number 2, the construction contracts. Now, this particular construction contracts also will have consequence, will have inventories, but that we will not cover in IAS 2. This has been previously discussed in IAS 11. But now what has happened, this has been superseded and now this has came into IFRS 15. Revenue from contracts with customers. So when we discuss IFRS 15, we will talk more about this. And the third one, the inventories from agriculture and farms. This we will not discuss here. This we will discuss on IAS 41. So these are the scope exclusion. The others we will discuss in IAS 2. So now we have discussed scope as well, and then we will now try to define certain technical terms. First we will try to define the definition: stocks or inventories. So what we mean by inventories? Inventories are 4 categories. It is goods available for sale in the ordinary course of the business. In the ordinary course of the business. So this is one scenario where these goods are known as inventories. So that is inventories available in the ordinary course of the business, or these goods which will be used for the manufacturing needs. Manufacturing needs, like now if we having a manufacturing plant and then we are producing certain item, for that we may have to use this particular item for the continuation of the manufacturing. So that is the second scenario. So the first one is known as finished goods, which is available for the purpose of resale in the ordinary course of the business. The second one is the raw material that can be used in our production process on a day-to-day ordinary course of the business. Third one, work in progress. That means this is also part of inventory that will be available to be consumed and utilized, and half manufactured, partially completed goods which will be used once it is completed, either to resell or to use in another different level of manufacturing. So that is work in progress. Sometimes we call it WIP. And the fourth one is consumable stocks, like bolt and nuts, grease, oil, and other type of item which are required as a consumables for the in our business process. So these are the definitions of this. First definition is inventory. That inventory is this, and then we need to define cost. The cost of inventory is any cost or expenses incurred for the purpose of bringing the inventory to its intended location and workable condition. That is the cost of inventory. So which is any cost or expenses that we will incur for the purpose of bringing the inventory to its intended location and workable condition. Now this cost, we have an equation: cost of inventory comprise of following. So the one is cost of purchase, the other one is cost of conversion, third one other cost relevant for inventory. Other cost relevant for inventory, that is cost of inventory. Now we will try to understand little more detail as to what is cost of purchase? The cost of purchase can be defined by way of an equation. The purchase price of inventory, that means supplier's invoice value, plus directly attributable cost. Now this, what you mean by directly attributable cost is that it is the all direct expenses such as transport, whatever the cost that you may you cannot avoid if you in need of bringing the inventory to your location. So all costs required to incur in order to bring the inventory to your intended location and workable condition are the directly attributable expenses or cost such as duty, freight, transport, loading, unloading, and sometimes special labors you may have to use and bring, like an engineer support or other related all these expenses. So these are directly attributable cost. Minus, you may get some benefits such as discounts from suppliers, rebates and subsidies from government when you are bringing down these inventories. So you will subtract them. So the net purchase cost is this. Net purchase cost of inventory is this. So that is cost of purchase. Then we have to talk about cost of conversion. So what is cost of conversion is that the if I write a equation for this, cost of labor whom you are using for the purpose of converting raw material into finished goods, and the overheads. The total of these two are cost of conversion. Now, cost of labor is slightly straightforward. You will then find out the directly attributable labor cost, so that we can we can utilize them. We can utilize them for the purpose of making our finished goods, raw material to finished goods. But however, the overheads are generally two types: variable overheads and fixed overheads. Now, with regard to variable overhead, again, it's the calculation or the treatment is slightly straightforward, whereas fixed overhead, we need to work out overhead absorption rate. And in calculating overhead absorption rate, we know that the budgeted overheads divided by budgeted activity. Now, when you talk about budgeted activity, sometimes we may have to use the normal activity. Okay, when the normal activity is given for the inventory, what are the number of units that we produce on a given year, that can be used as a budgeted activity, and then you can calculate the overhead absorption rate and then incorporate that in arriving the total overheads. Plus the variable overheads are directly proportionate to the activity, so therefore it won't be an issue. So the total of these two will give you the cost of conversion, and then we may have to talk about other cost. The other cost are direct expenses which are not purchase cost or which are not conversion cost, such as royalty expense, or any other directly attributable expenses. Directly attributable expenses. We will take all these totals and that will give you the cost of inventory. So this is the next definition. So we have discussed the cost of inventory, and the next one we have to talk about net realizable value. In short, we call it NRV. So what is net realizable value here? This is estimated selling price minus the total of estimated completion cost plus estimated selling expense. So when we take the total of estimated completion cost and estimated selling expense, and then we subtract this from the estimated selling price, the answer is NRV. Okay, now these are the definitions, and now we need to find out initial recognition. So inventory should be normally recognized at cost initially. We should recognize the inventory normally at cost initially. However, inventory should be computed. Inventory should be computed the NRV2. We need to compute the NRV2, and then what we need to do? We need to compare the cost and NRV of the inventory. Cost and the NRV have to be compared, and then we need to come up with a conclusion when the NRV. Now remember here, please remember, normally NRV is expected to be greater than cost. Hence, inventory will normally measured at cost. But in case if NRV is less than the cost, then the inventory should be measured at NRV. That means I dot T dot when NRV is less than cost, we should measure at or value at NRV. Now suppose, let's say the cost is 100, we valued that on 31st December 2020, and the NRV on became 80 on 5th of January 2021, then we should remeasure. We should remeasure the inventory at NRV. That means we have to remeasure at 80. So there is a difference of a reduction of 20. This reduction we should take to transfer to P&L as expenses. So other point is, when we are measuring inventory, we have to measure inventory with the entire class. So you have to group together and measure, so that there can't be any excuses where in group, let's say in inventory class 1, you have 4 inventory item. Inventory item 1, 2, 3 and 4. Inventory 1, 2 and 4 are cost is less, and inventory 3 is NRV is less. Now in this case, you can't rule out inventory 3. You only planning to measure 1, 2 and 4 and ignore 3. No, you can't do that. You got to measure entire class. So that also please remember as part of your knowledge. Now there are expenses which cannot be classified as expense for inventory. These expenses should be taken to profit and loss account and write off as expense. Write off as expense. The other point is that example are admin expense, marketing expense, pre-manufacturing or production expense, pre-manufacturing or production expense, and in storekeeper salary, production factory manager salary, and so on. So this has to be not considered as part of cost of inventory. And also the other type of expenses which you cannot inventory damages and so on. See, another scenario, the possibilities of when NRV becomes less than cost. That is when one point is that when inventories are slow moving or obsolete. So this is one situation. 2, when inventories are damaged. That is second situation. Third, market condition. Market condition is very poor. And the other possibility is that reputation of the business is gone. And then number 5, going concern is lost. So these are the situations where the NRV becomes less than cost. The other point is that once inventory is sold, then such inventory must be taken to cost of sales. You should take them to cost of sales. And then we also need to talk about inventory count. Inventory should be counted on a regular basis, like generally monthly or biannually or quarterly or at least annually, and to arrive the valuation of inventory. To arrive valuation for inventory should be counted. Inventory should be counted. And inventory cost should be arrived using one of the following method. Which are, one is standard cost method. Here what we do is, every business will have a standard cost card, and then we will use that standard cost card and then value the inventory. For example, let's say I have 1000 quantity and my standard cost card said per inventory my cost is 20. So the value of the inventory will be $20,000. So this is standard cost card method. Number 2, actual method. In actual method, IAS 2 recommends 2 things. One is FIFO. We will use the first in first out method. Number 2, weighted average method. Using one of these 2 assumptions, we will try to arrive the cost of inventory on this basis. Remember, there is another method, last in FIFO. This has been cancelled by IAS 2, so we will not be discussing that. So, and then finally we need to talk about disclosure relating to inventory. One of the disclosure is accounting policies with regard to inventory valuation. That means what method we have used. Either we have used FIFO method or weighted average method or standard cost card method. And then the details of the cost of sales. And then any slow moving or obsolete inventories. Any slow moving or obsolete inventories. And we also will show when the NRV is less than cost situation. So these are some of the disclosures, and with that I conclude the discussion of inventory, accounting for inventory, and thank you for watching this. And if you have any questions or doubt on this topic, please do not hesitate to contact me. My personal contact details are atif83@gmail.com or my WhatsApp +94 777 654509. I would be more than happy to help you should you have any doubts and questions, inventory, or even for that matter any accounting or any other financial management and reporting or auditing issues. Please do like this video. Kindly share to any others who would be benefited from this. Also subscribe my YouTube channel so that everyone will be benefited by receiving any brand new and fresh new content, and also press the bell button for the benefit of everybody. Thank you so much for watching this discussion, and await for my next discussion IAS 7 on my next video.